Every empire swears its money is solid. Every government insists its currency is backed by something real. And almost every time, history patiently prepares a reminder: nothing backed by human promises is permanent. For most of the 20th century, the world was told that the US dollar was as good as gold. Literally, $35 for 1 ounce. That was the deal. Governments saved in dollars. Central banks stacked dollars in their reserves. Trade contracts, loans, oil payments all ran through this promise. $35 equals 1 ounce of gold. And then, on a calm Sunday evening in August 1971, a single television address quietly ended that promise. No collapsing banks on the screen, no mobs in the streets, no dramatic gold heist, just a man in a suit, reading from a teleprompter, announcing a temporary suspension that would never be reversed. Overnight, money lost its anchor. The world woke up with the same pieces of paper in their wallets, but those pieces of paper no longer meant what they had meant the day before. To understand how much changed in that moment, you have to go back to a different crisis, in a different century, when the world tried to rebuild something that felt safe. It is 1944. Europe is still burning. Cities are rubble. Factories are wrecked. Millions are dead or displaced. But in a quiet hotel in Bretton Woods, New Hampshire, representatives from 44 allied nations are doing math. One country is different from the rest. The United States. Its factories are intact. Its infrastructure is untouched. Most of the world's gold sites in its vaults. Its currency is stable. Its armies are on the winning side. So a deal is struck. Every major currency will be pegged to the US dollar. The US dollar will be pegged to gold, $35 per ounce. Foreign central banks, not ordinary citizens, get the privilege, bring in dollars, take out gold. On paper, it looks like a solid compromise. No more chaotic currency wars like the 1930s. No more competitive devaluations. The dollar becomes the sun at the center of the monetary system, and every other currency orbits around it. But built into this elegant design is a slow, unavoidable problem. As the world recovers, as trade grows, as factories in Germany, Japan, and elsewhere start humming again, global commerce needs more dollars. Dollars to buy oil, dollars to settle trade, dollars to hold as reserves. The global economy is like a machine that drinks dollars as fuel, but gold is not expanding at the same pace. The pile in U.S. vaults is large, but not infinite. The promises tied to that pile grow year after year. Dollars flood out of America to pay for military bases, foreign aid, imports, and corporate expansion. More claims on gold, fewer ounces of gold relative to those claims. An economist named Robert Triffin points out the contradiction in the 1960s. For the world to have enough dollars to function, the United States has to run deficits. It has to send more dollars out than it brings in. But the more it does that, the more everyone begins to doubt that those dollars can really be converted into gold at $35 an ounce. The system needs the very behavior that will eventually destroy the system. That is the Triffin dilemma. It is not a bug. It is baked into the design. By the late 1960s, the contradictions moved from academic papers to hard reality. The United States is spending heavily. The Vietnam War swallows money. Domestic programs cost more than expected. Political convenience is simple: borrow, print, and promise. Foreign governments are not blind. They see gold flows. They see statistics. They see an America promising the same ounce of gold, in effect, to more and more holders of dollars. If you are a foreign central bank and you hold billions of dollars, what do you do if you suspect the promise will not hold forever? You call it in? Quietly? Firmly, while the window is still open. France under Charles de Gaulle begins to do just that. French ships show up to exchange dollars for physical gold. Other European countries follow more discreetly. Gold flows out of U.S. vaults ton after ton. The more that leaves, the more everyone else worries. The more they worry, the more they demand gold instead of paper. This is what a slow-motion bank run looks like at the level of nations. No shouting in line, no shattered glass. Just telegrams, ships, and ledger entries that drain the anchor from the system. The United States faces an old choice with a modern twist. Honor the promise and keep redeeming dollars for gold until the vaults are dangerously low, or admit the promise can't be kept and change the rules. On August 15, 1971, the rules changed. President Richard Nixon appears on television. He does not say, "We printed too many dollars." He does not say, "The math doesn't work anymore." He blames international speculators for attacking the dollar. He frames it as a defensive move to protect the American people. He uses one phrase that sounds harmless, almost boring: temporary suspension of the convertibility of the dollar into gold. Temporary, like emergency measures that never quite end. Behind the language, the reality is blunt. Foreign governments can no longer take their dollars to the U.S. Treasury and demand gold. The official door between paper claims and metal is shut. The last formal link between the world's reserve currency and a physical anchor is severed. The ship cuts its chain. For the average person, nothing explodes. Banks open on Monday. Employees still get paid. Shops still accept dollars. Life goes on. But underneath, something fundamental has shifted. Before 1971, money was at least formally tethered to something scarce. After 1971, money is whatever governments and central banks define it to be, in whatever quantity they decide, constrained only by politics and confidence. Think of money as a ship in choppy water. Under Bretton Woods, however flawed, there was a heavy chain attached to the seabed, gold at $35 an ounce. The chain rattled, stretched, and sometimes threatened to snap, but it existed. Politicians could argue. Central bankers could maneuver. The chain was still there, limiting how far they could drift. In August 1971, the chain was cut. At first, the movement felt like freedom. Without gold as a hard limit, governments suddenly had more room. They could run larger deficits without worrying about draining their vaults. Central banks could respond to crises more aggressively. They could lower interest rates, expand credit, and experiment with policies that would have been impossible under a strict gold link. The modern era of pure fiat money begins in earnest. Money by decree, not by metal. Currency backed by law and expectation, not by something you can hold in your hand. Freedom from an anchor always looks like an opportunity at first. New tools, more flexibility, fewer constraints. But removing a physical limit doesn't remove risk. It just moves the boundary line somewhere else. Instead of being limited by ounces of metal, the system is limited by ounces of trust. Trust in the currency. Trust in the managers of the currency. Trust that, whatever happens, the value of that paper or those digits won't be allowed to evaporate. The 1970s quickly show what happens when the leash is lengthened and politicians use it. Oil shocks hammer the global economy. The price of energy jumps. Governments respond in familiar ways. More spending, more support, more attempts to smooth the pain. Central banks accommodate. The number of dollars in circulation grows. The link to gold is gone, so there's no external constraint to force discipline. The result is not subtle. Inflation surges. Prices climb in ways ordinary people can feel in rent, groceries, fuel, and wages that never quite keep up. In less than a decade, the US dollar loses a large chunk of its purchasing power. People who trusted cash as a safe store of value quietly pay the price of the new system through rising costs and eroding savings. Eventually, in the early 1980s, interest rates are driven brutally high to crush inflation. The medicine works, but the message is clear. Without an anchor, the value of money becomes a policy choice, a knob to be turned, not a weight on a scale. Over the next decades, a second transformation unfolds, one that touches almost every part of modern life. When money is unanchored, credit can multiply. Banks, freed from a scarce reserve asset, can expand lending in step with regulation instead of geology. Governments can issue more bonds. Central banks can support markets with tools that did not exist before. Slowly, and then quickly, debt levels explode. Household debt, corporate debt, government debt, global debt. The charts all tilt upward after the early 1970s. The system adapts to this new reality. Growth, markets, and political promises start to rely on ever cheaper borrowing. Asset prices are pulled into the same orbit. Stocks, bonds, and real estate no longer reflect only earnings, productivity, or rents. They respond with increasing sensitivity to interest rates and central bank speeches. A sentence from a central banker can move trillions of dollars in a few seconds. In a world without gold as an anchor, policy becomes the new gravity. Defenders of the post-1971 system argue their case. They say flexible money has helped avoid deeper depressions. They point to the ability to respond to crashes, pandemics, and banking crises with rapid stimulus. They note that global growth since the 1970s has lifted hundreds of millions of people out of extreme poverty. There is truth in those claims. A rigid gold standard can be brutally unforgiving. It can force deflation, it can crush debtors, it can amplify recessions and make adjustments slower and more painful. But a crucial question lies underneath the debate. The world did not move from a bad anchor to a better anchor. It moved from an anchor to no anchor at all. Before 1971, a government that wanted to fight a long war or build a massive new program eventually ran into a physical limit. Gold was finite. If promises outgrew metal, the contradiction became visible in dwindling reserves. After 1971, the limit shifted into softer territory. How much will bond markets tolerate? How long will voters accept rising prices, rising inequality, or rising debt? How much confidence will remain after each intervention? Gold doesn't attend press conferences. It doesn't read headlines. It doesn't watch approval ratings. Confidence does. This shift also changes who pays the price when things go wrong. In a world of anchored money, a crisis might force devaluation or a painful reset. In a world of fiat money and massive credit, crises are often met with responses that quietly transfer losses. Inflation eats the value of savings. Asset price booms benefit those who already own assets. Bailouts protect institutions first, and ordinary workers last. When money lost its anchor, it did not become neutral. It became a more elastic instrument of policy. And policy, inevitably, serves some interests more than others. The consequences show up in your daily life, even if you never think about 1971. When the price of a home rises far faster than wages over decades, that is part of the long shadow of unanchored money and easy credit. When university tuition spirals upward, when the cost of medical care outpaces inflation, when assets make people rich while savers and cash fall behind, you are seeing what happens in a system where creating new money and credit is easier than admitting hard limits. When crises hit, the pattern repeats. In 2008, in 2020, and in any future shock, the instinct is the same. Cut rates, expand balance sheets, create money, backstop markets. The tools are modern, the screens are digital, but none of it would be possible at this scale without that original decision to detach money from something physical. The old question was simple: is there enough gold? The new question is more dangerous: is there enough trust? Trust in the currency, trust in central banks, trust that inflation will stay under control, that bonds will be honored in real terms, that each new round of intervention will be the last big one for a while. History gives a clear answer. Trust is not a number on a balance sheet. It is a mood. It holds until one day it doesn't. This is not a call for nostalgia. Gold bars and vaults do not magically create justice or stability. Past gold standards produced their own crises, panics, and collapses. They punished some groups harshly and rewarded others. The deeper lesson is simpler and sharper. When money has no anchor, it becomes three things at once: a political tool, a confidence game, and a claim on a future that may not match the promises made in the present. The Triffin dilemma did not disappear in 1971. It just morphed. The world still needs a reserve asset. The dollar still plays that role. The difference is that now the backing is not metal, but belief in the system that issues it. Belief in growth, belief in order. Belief that no matter how large the numbers get, someone somewhere is in control. For the unprepared, this is a dangerous assumption. Because when money is anchored only to trust, every crisis becomes a test of faith. A test governments try to pass not by shrinking promises, but by stretching them. If you want to understand your position in this system, look at where you hold your wealth. Paper claims or real assets, cash or productive capacity. Promises are things people will value through multiple regimes. Every crisis in history has been, at its core, a transfer. From those who believed too much in official assurances, to those who quietly prepared for the possibility that those assurances might fail. From paper to substance, from nominal to real. In 1971, most people did not notice that the transfer line was moving. They turned off the television and went to bed. The announcement felt technical. The numbers felt abstract. The real consequences unfolded over years, then decades, reshaping prices, debts, markets, and politics so slowly that only the charts tell the full story. You live in that story now, in the age of floating currencies, towering leverage, and central banks as permanent firefighters. There are advantages to that world. There are also fault lines that many prefer not to see. You cannot go back to Bretton Woods. You cannot reattach the chain that was cut, but you can stop pretending it is still there. You can stop mistaking digits on a screen for bedrock reality. You can recognize that when money lost its anchor, responsibility shifted more heavily onto individuals to build their own. Because when the tide of confidence moves, and history suggests it always does, the people who understand what happened in 1971 will be less surprised by what disappears. History has shown again and again that systems change quietly before they fail loudly. That promise multiplied faster than resources. That anchors are cut in calm language long before storms arrive. Nixon 1971 was not just a line in a speech. It was a hinge in monetary history. The day money stopped pretending to be a receipt for something real and became, openly, a story everyone agrees to believe. Stories are powerful. They are also fragile. History has the answers. Look where it points.